Okay.
All right. Well, it's just about 7 p.m. and it's time to talk about global investment strategy. And tonight I'm going to be going through the strategies that I do together with InnovestX. And I welcome any questions that you guys may have. I'm going to talk about the different strategies and also talk about my thinking about what's going on globally in the world of investing. It's such a difficult time because we've got the potential of a recession. We've got inflation coming down, but starting to come back up. We've got inflation somewhat low in the developed markets, but kind of a little bit higher in some of the emerging and frontier markets. And then we've got also the interest rate so high in America that it just seems like it's got to go into recession. So there's so many things. In addition, we can see that inflation in China has started to go into the negative territory, meaning deflation. Deflation in China, who would have ever thought we would have seen that? And these things all together make it a really interesting and unique situation from my perspective as I'm watching, what's going on. So I'm going to walk through strategies, but also welcome any questions that you guys may have. So just want to say hi to everybody out there. Welcome to the stream. Tirada, good to see you. Nice to see you. And for everybody else, welcome. And make sure you ask questions. That's the whole point. I've got a lot of stuff that's in my head that I'm happy to share and my thinking on things. But I'll tell you, one of the funniest things happened to me today was one of the coolest things is that I got to speak at a university class on finance. And it was of my first professor in finance back at Cal State Long Beach. I graduated in 1989, and this guy taught me, and he invited me to teach to his class today. And that was so exciting. So it was really nice to go back in time and to talk about how I built a career in finance that I really love. So today I'm going to be talking about the portfolios and what we're doing. Just want to say hi to everyone. Ganchina, and also Sawadee Krap. I see that you say that. Now, I can read a little bit of Thai, so I can read Sawadee Krap. And Nat Suchira says, hello, John Andrew. It's good to see everybody. And I'm looking forward to tonight. I'm going to pull up my presentation in just a minute and start to go through some of the things that I'm seeing. Now, I'll tell you that the performance of my strategies right now is not, I'm not that happy with it. I wish it can perform better, but I also know the key to investing is to stick with the strategy for the long term. I've developed my strategy over many years, and I know that sometimes it works, sometimes it doesn't, but in the long run, I know the value is staying invested. So I'm going to talk to you a little bit about that. So let's get started. I'm going to bring up my presentation here, and you can see it right there. And I'm going to run through a few parts of this presentation now. And first of all, remember, ask your questions in the chat. I love questions. So please feel free to ask any questions, and I'll do my best to answer them. So our allocations are global, and they're long-term, and they're diversified. That is a key to what we're trying to do. And I believe that by being long-term and diversified, as well as global, we are creating the best portfolio that we can. So that's what the strategies are about. And I just want to remind everybody, why are we here? Why take this time tonight to come together? Why? Because we're here to build wealth, but most importantly, build wealth over the long term. Now, I see three pillars of investing. One is to be broadly diversified, and the second is to contribute regularly, and the third one is to stay invested. Many people get that third one messed up because they get out of the market, then they get into the market. But my challenge to you that I've really learned over the years is the power of staying invested in the market over a long period of time. So these are what I would call the pillars. And also, just to highlight, there's 12 steps to financial independence as I see it. The first is create a plan and follow it. The second is to keep investing simple. The third is to start early because time really is money. And the fourth is to get realistic about stock market returns. Number 5 is do it yourself. Number 6 is avoid mistakes when you're young. Number 7 is build wealth through savings. Number 8 is keep financial costs low. Number 9 is diversify to reduce risk. And number 10, own both stocks and bonds. And 11, trade infrequently. And 12, stay invested and watch it grow. I discuss these in my book, How to Start Building Your Wealth Investing in the Stock Market. That book is available in both Thai and English. You can get it on Amazon, or you can get it on Shopee or other places in Thailand. And also, I have a course that I do in relation to that, which you're welcome to try. So just to take a moment, I'd like to highlight these principles for investing because I feel like some people, they want to hear about what's happening in the stock market today. What is the strategy that we're pursuing right now, and daily trading and all that. But the truth is that I am thinking long term, very, very long term. And that's, I think, what people find in my strategies that they appreciate. So before we go any further, let's just, we do have Chatri, who says, happy to see you again, Dr. Andrew. Could you give your opinion about gold in this situation? Yeah, it's interesting about gold right now because interest rates are super high in America right now, at least in treasury bonds. So why own gold? And people think it's a soft landing. So why own gold? People think that the US dollar can stay strong. So why own gold? So I would argue right now, gold is just not that attractive. And in fact, in my strategies, I have a low weighting in gold. Eventually that will change. But right now, that's the case. The other thing I would say about gold is the way I look at gold is I look at it as a defensive asset to protect some damage caused by the downfall in my equity position. Remember, in the end, it's stocks and companies and equity that's going to give us the long-term return. It's not gold, and it's not even bonds, and it's certainly not commodities. Ultimately, it's stocks. And so we want to stay in stocks, but use gold as some sort of protection. Pakon, good to see you. And also, I see Katai Rapid say hi. Nice to see you. And also, NKY, is US tech stocks still fine, or should I sell the sector out of the portfolio? I would say that this is a challenging question. The first thing is we know the valuations are high. Definitely there is a tech, there's a huge tech rally. Would I call it a bubble? No. It's not like the tech bubble of 2000 or 1999, because in that tech bubble, none of the tech companies were making much profit. But now we have tech companies making huge profit. Now, where the risk is if those profits start to fall at tech companies, then you could see a derating in tech companies. So if I was adding tech to my portfolio over the last couple of years, I definitely would be taking some, I would trim some of that position now, because I know in my career in the stock market for more than 30 years now, I can say that what goes up must eventually come down. So feel free again to ask any questions that you guys may have. I'm going to bring my presentation back up onto the screen and walk through it. So I always like to remind people that you won't get rich in the stock market, right? You should view the market as a place to grow and protect your wealth. You create wealth through your business or your salary. And I've created these strategies to help you become financially independent. And if you're already financially independent, congratulations. My goal then is to help you stay that way. Now, remember, you can get access to all of these strategies through the InnovestX app. Remember also that this is an important thing to remember that I just want to share with you. I'm not your advisor. I am providing these strategies to InnovestX, and their research team, and then they vet that and bring it to the app. So I can't give you advice about exactly what to do, but what I can do is present the information that I'm presenting to InnovestX. So let's continue on. So our goal is to deliver steady returns over the long run. Now, these are the 3 strategies that we launched about a year ago. And what we can see, and this data is updated right now until August. What we can see is GIPS, the global inflation plus strategy, is low risk. That's the red line. And you can see it's just kind of slowly going up, and it's low volatility. That's what we're trying to do with that one. And GAZE is medium risk. That's the global asset efficiency strategy. And that medium risk has actually been doing very well. And the third one is GAS, which is high risk. And the high risk portfolio has done less well. It's down to 96.4. It started at 100. And generally, when you go into the high risk GAS and the market's just not that great at the time, then it's very likely that we have underperformance, and certainly that we have volatility. So now I do see a question coming up from Jarungsa, and that says, could you suggest a strategy that suits for this market situation? Well, I would say the first one I would say is that it's so hard to try to figure out what is the market situation. I think that if I was talking to a person like yourself that's asking me for advice, I would say, look at your own situation. How much money do you have to invest? How significant is it? Are you going to have to pull it back out, or can you just leave it in there for 5 years, 10 years? And therefore, if that was the case, for me, I like the gas portfolio because it is high risk. And that means in the long term, it's going to have a higher return. That's my hope. And that one is not that expensive now at 96.4. Of course, if you say, well, Andrew, I'm just not sure about the risk level of that, then I think you could go with the global asset enhancing strategies, or what we call GAZE. That's the blue line there. So Jarungsak, it really depends on your own situation, but those are some of my thoughts on it. So again, for everybody, feel free to ask any questions. Now, gas hasn't performed well year to date. But higher risk means a higher likelihood of deviations. And eventually, when we see the markets come back up, my expectation is that the gas portfolio will perform more positively than the others. Now, we create our strategy. It's funny that, we're looking at these strategies and talking about the performance over a month, or over 6 months, or over 12 months. I had a guest on my podcast named Meb Faber, and he's pretty famous in America. And he asked the question, how long should we go with a strategy that doesn't perform? And his point was 10 years. It was incredible what he was talking about. But the idea is that we all know that no strategy is going to work every month or every year. And therefore, we know it's going to underperform. And sometimes it makes sense just to sit and wait for that strategy to come back. Again, it depends on your situation. But for me, not even a decade is really long term. There's a picture of me when I was a kid, and there's me when I moved to Thailand, and there's me when I'm 100, I hope. So my aim is to create strategies that perform over many decades. So let's go through. We're going to review the performance and then look at the GAZE strategy was down 1.9. And we're looking at August, and alpha asset strategy, the global alpha asset strategy, or the gas, was down 1.3, and global inflation plus strategy was down about 0.1. And then I'm going to look at global outlook that guides our asset allocation. So now let's do a little performance review. In fact, I'm going to stand up while we're doing this. So I'm going to move my desk to be in a stand-up mode, so I have a little bit more energy for that. So this is the GAZE portfolio, and what we can see is that the strategy since inception was up about 4.8%. And here we can see the benchmark was up 109. So we actually did okay, but we performed a little bit under the benchmark. So here we can see For the month of August, the strategy was down 1.9%, which was 0.3% above the 60/40. So it did okay during that period. Now, our allocation to Japan did relatively well. As you can see, emerging markets, Asia ex Japan and the like were hit pretty hard, but we didn't have major weightings there. Our 25% gold allocation kept up better than most of the equities. So gold did help us during the time that we were holding that. And then, of course, our worst position was the developed Europe position, which was down 3.8. So that was the performance in the month of August. Now it's time to announce our target allocations as of the last revision, meaning these have already been executed now through the InnovestX app. And here, what you can see is that we've raised our equity to 85% and we've reduced gold to 5%. And the 85%, as you can see, is going into the US. So we're maintaining our overweight to developed market Europe and Japan within equity. And we're raising US equity to 25% from 5. Now, you may say, Andrew, why are you going overweight US? Well, this isn't overweight. In fact, we were significantly underweight at 5%. Remember that the US is 60% of the overall global market. And so I would say we're neutral or even slightly under neutral. Also, we've switched to global bonds from Thai money market bonds. Global bonds are yielding a very high yield these days, and so they're more attractive in my position right now. And again, we've reduced gold to 5% from 25. Now, let's go through the second strategy. This is the gas strategy, and this was the strategy that is, the most aggressive of them. Since inception, the strategy has been down about 3.6%. And you can see it's definitely underperformed the 70/30 portfolio. And basically, our allocations just haven't really been working that well right now. But, I've seen that over many, many, many years that you're going to have some months that could be not so great or could even be, serious underperformance. But eventually, what we're doing with our FVMR strategy, it comes back over time. Now, in the month of August, the strategy was down 1.3%, which was 1.1% above the 70/30 portfolio. So we did okay relative to that, but still negative. The strategy was 1.8% above world equity. And out of our bigger tilts, bonds, healthcare, and gold were the best performer in August. Now, let's announce our target allocations as of the latest revisions. Again, these have been executed into the portfolios already through the app, through the InnovestX app. So let's see those changes that we've made. So we keep equity at 68%. What you can see is within equity, we've moved 3% to Latin America from precious metal miners. And we've switched to global bonds again from the Thai money market bonds to try to pick up yield. And the remaining target allocations all stay the same. So that is our update on the weightings. Now, let's look at the global inflation plus strategy. Those are for people that are looking for a relatively low risk strategy, maybe to take deposits out of the bank and put it into this type of strategy. And here we can see since inception, about a year ago, the strategy was up about 1.9%. Not a bad return, about 2%. Now, my goal is to get that to 4%. But for right now, I just like the stability of it. Now, if we put that against our benchmark, you can see we're down a bit from the benchmark. But again, I expect a lot of ups and downs like that. But ultimately, the goal is to stay the course, stay focused on the structure of what I do, which is FVMR. And maybe I'll just talk briefly about that in just a moment after I wrap this up. So the strategy has experienced a lot less volatility. You can see right there, the red line is much more stable. And here in August, the strategy was down 0.1%, which was 1.8% above the 40/60 portfolio. Bonds and tips especially did well as equity fell. And the World Equity Fund that we use in the strategy outperformed the MSCI World Index. All right, This is our final allocation announcement. Remember, this has already been executed into the InvestX app. And here you can see that we've kept the equity at 25%. The key is that we're changing our core bond allocation to global bonds from Thai corporate bonds in line with our global strategy. And we're reducing the tips and gold by 5% respectively and moving that to global bonds. So before I go into the outlook, I will take some questions, any questions that we have, but I also just want to highlight over the past 10 years, I've been developing this investment strategy that I call FVMR. And the FVMR strategy stands for fundamentals, valuation, momentum, and risk. Basically, I'm always looking at the market from these 4 angles. And from those 4 angles, I come up with using a lot of coding and a lot of testing that I've done, I come up with a scoring system. And from that scoring system, it helps me allocate towards to some sectors and to some countries and away from others. And I've been following this strategy for almost 10 years now. And I've learned a lesson, which is no matter, even if performance is bad, just stay focused. And I know for a lot of my clients, they're on a roller coaster ride of ups and downs in the markets. And by following me, you don't go on a roller coaster ride because I don't manage money that way. So, Arawat says, what's your suggestion on US tech stocks? Are they cheap enough to invest? I would say at this point, if I had a tech position, I would start trimming a portion of that position, 10%, 20%, 50%. That kind of depends on the risks that you bear. But what I've seen in my career is that when valuations go up very high for any particular sector, what we see is that eventually that comes back down. Now, if I didn't have any exposure to the tech stocks and you just bought into something like you executed these strategies on the InvestX axe, you would get exposure to those tech companies, right? Because if you own S&P 500, you're getting some tech exposure. If you're owning NASDAQ, you're getting some of that tech exposure. So I would say that tech is not cheap enough yet to go rushing in. What is cheap is the Russell 2000, which is 2,000 mid-cap companies in America that are really actually quite cheap. All right, keep your questions coming. If you've got any questions, feel free. I'm going to go into my next session in just a bit where I'm going to talk about what I'm seeing in the global economy. But before that, let me get another question. Lynn Meat says, please let me know your opinion on the China market. All right, China. I'm still not positive on China. And the reason why is because, number one, we're facing deflation now in China. Number two, we've got a property company crisis. And I know that property crises have a lot of pressure on the banking system. Why is that? Because property is the ultimate collateral. And if the collateral values are going down, then banks are requiring more and more capital. Now, the Chinese banks have the support of the state, so maybe they won't get crushed by it. But I definitely know that there's some pressure. Now, add on top of that, in fact, I was just talking to my professor, Dr. Lu Wei, who is my professor back in China that I studied with when I did my PhD. And when we were talking about it, you can just feel, he didn't express it explicitly, but I could feel from his talking that people are risk averse right now in China. And I have 2 friends of mine that came to see me from China and came to my house to sit down and talk. And they both said the same thing, which is that people are scared now in China. It's harder to do business. They don't feel as positive. And this type of situation, I would say, is pretty negative, for China, because if the sentiment turns negative in China, then it's going to be very hard to turn the economy. The last reason why I'm still negative on China as of right now is that I think the U.S. is on a war path to go to war with China. And the end result is that whether the U.S. goes to a official war or not, I do think that the U.S. is going to do things that's going to keep FDI investment from getting into China, that's going to cause other problems. We've already seen them try to ban certain exports of certain tech equipment and stuff like that, and semiconductors. And so that's also going to be a problem. And that means that it's harder for Americans to allocate money to the Chinese market. So I would say either now or over the next 12 months, we could be in a situation where the Chinese market is really getting to kind of an official bottom. Another question, how about Vietnam and Thailand market? Let's talk about Thailand for just a moment. What I would say about Thailand is that it's still not attractive relative to the other countries in the region. When I look at Asia, Thailand's still not attractive. India is attractive. Indonesia is attractive. But what I would say is that in the next 3 to 12 months, or sorry, 3 to 6 months, I expect that the Thai market will start doing well. In fact, my latest work where I talk about the 5-year returns in the equity market, my expectation for the US is 6% for average annual return over the next 5 years. And my expectation for the Thai market is 9.5. The Thai market has been derated for about 6 years now, and it's really had 10 years of terrible performance. And that is a time when everything's down that you want to start adding to some of your Thai positions. And I think eventually foreign fund managers will come back and invest in Thailand over time. Vietnam, I think, Vietnam has a lot of good things going for it. It's benefiting from this tension between the US and China. And in that case, Vietnam is getting more foreign direct investment and more support from the US. So, from a longer term perspective, Vietnam should be in a pretty good position. But as far as my weightings and any allocations, I don't have any overweight position in Vietnam right now. Okay, Sibto says, can you give an outlook about interest rates in the US next year? Yes, I can. Here's my forecast for US interest rates by the end of this year or the end of first quarter. My expectation is 0. US interest rates are going to go back to 0. That's my forecast. That's my expectation. Right now, let's say short-term interest rates in the US are at 5.5% or wherever the Fed funds rate is right now. And what I'm expecting is that we are going to get a recession in fourth quarter of this year, and it may hit in first quarter of next year. But the inverted yield curve pretty much tells us that it's coming at the end of this year. In addition, we have a lot of other signs that are telling me that we're getting a recession in the US. So I am not in the camp of soft landing, Sibto. I am in the camp of hard landing, and eventually the Fed's going to come in and have to cut interest rates again. And what's going to happen is that the Fed's going to be the buyer of last resort of bonds and of mortgages and all that. And then the Fed's going to go in and start doing QE again. So that's my expectation. It's a little bit, maybe it's a little bit extreme. Now, let me just go back to the strategy a little bit, and I'm going to talk about some of the things that I'm seeing right now. So first of all, central banks are battling inflation while trying to avoid a severe recession or a banking crisis. And I suspect they're not going to be able to manage that too well. And the recession versus no recession debate continues. As you can see, I'm on the recession side, and sentiment appears to be in favor of the no recession side. And then the expected pause in the Fed rate hikes could support equities, right? If people are expecting that the Fed was going to rise and then they didn't, that should be positive for equities. And eventually, Sibto, you may be asking, well, Andrew, if you think interest rates are going to come down to 0, what do you think I should do with equity position? Well, I think part of the reason why I'm taking a higher position in equity in the US is because if I'm right and we go into recession, initially stock market could take a hit, but eventually I think the Fed's going to step in. And when they do, the market's going to fly, because when you've got a deep pocket buyer or supporter of the economy coming in there, it's pretty significant. Now, let's look at oil price, which has rebounded. And this is creating some inflationary pressures. I calculate this world inflation by taking the data on every country and then weighting it by its GDP. So the volatility of energy prices is a reason that central banks look at core inflation because it excludes food and particularly energy. Though if the oil price continues up, it could reaccelerate inflation as it's a key input for many industries. Let's get this one thing really, really clear. Oil up, inflation up. There's no way around it. If oil prices go up, inflation goes up. And that's the challenge that we're going to be facing. Now, remember, we're heading into an election year in the U.S. Joe Biden, and the Democrats want to keep the economy strong. It's part of the reason why I think if we start to move into a recession, you're going to see the Fed act pretty strong. And so that's what I would say right now is that going into an election year, they're going to try to prop up the economy. Now, in December, I'm going to talk about my forecast for who's going to win the U.S. presidential election. I haven't finished that research, but it's in process. So now let's continue and let's just look at some other things. First of all, the 3-month government bond yield has risen to 5.1% from 3.0 a year ago. And of course, central banks are battling inflation while trying to avoid a severe recession or a banking crisis. Rates have come up quickly and inflation has come down. So I expect pauses or slower hikes from central banks. Now, the question is, do we have a recession ahead? Here we can see that this is the fastest and most aggressive rate hike cycle by the Fed since 1980s. And after the 0.25% hike in February of 2023, the current rate hike cycle became the most aggressive since the 1980s. The Fed has hiked rates by 5.25% in this current cycle. That's a huge increase, and it can cause a lot of damage. Now, this has resulted in a yield curve inversion. And here we can see the yield curve inversion has dived deeper, and ultimately all recessions in the U.S. Since 1968 have been preceded by an inverted yield curve. So this is a very important signal. Now, it could be wrong. I know even the guy who came up with this concept of using the inverted yield curve for predicting recession, Campbell Harvey, he himself thinks we're not going into a recession and that the yield curve inversion is not signaling a recession. But if it is, which I think it is, the average time from inversion until the recession started was about 1 year, which means it's going to happen in fourth quarter of 2023. This is part of the reason why I say we'll probably be in recession by the end of 2023 or at the latest, the end of first quarter 2024. So here we can see the market expects a continued pause in November of 2023. The market is pricing in an 82% probability for the rate to remain unchanged at the next FOMC meeting. And a pause could mean a delay in the recession. And a pause could also be positive for equity markets. But of course, it's got to be a pause or even a fall to be a surprise at this point. So the expected rate curve has shifted up significantly since May. As you can see, at November 6th, 2024, in May, people were expecting the interest rates were going to go down to about 3.1%. But now they're expecting almost 4.8%. So a lot higher expectations there. And if we look at the next thing, right now, the U.S. is now at peak employment. And you can see strikes are happening at the U.S. Part of it is that the workers are saying, hey, we need to get some benefits here. And that's what's going on right now. And I'd say that there'll be more pressure on wages. And, as we can see, there's not a lot of union activity in the U.S. anymore. But the automobile union workers did put pressure on the automobile companies. Now here, what I can see is that peak employment precedes the recession. So some people say, Andrew, how could we go into a recession if unemployment is so low? In other words, employment is so strong. But you have to understand that is ultimately a sign of a potential recession. And so I'm expecting that coming up. And here we can see the composite leading indicators ticked up just a little bit recently, but still is under the 100. And again, I'm a little bit nervous when I start to see that. And here we can see that valuations, the red line, have risen as price has rebounded year to date, but still below one standard deviation. Also, what's interesting about this, and I'm going to pull up my my pen to write on this chart. So let me do that. And what you can see is that the blue line is the net margin. And if we take the average of the blue line, we would have ended up, let's say, at about 8.5% net margin right here. And at the peak, we were up at about 11%. Right now, we're at about 10.5%. So I think that eventually when we get to the recession, we're going to see a downgrade in earnings. And if we see a downgrade in earnings, we're going to see an increase in PE. And so that's something I think you want to be careful about. Right now, it looks like the market's not expensive. But if we do see downgrades in earnings, all of a sudden the market will seem more expensive. Now, for the past year, I've said that we think the course will eventually be reversed, right? I'm still expecting that central banks will reverse course and return to accommodative policies, meaning they're going to go back to zero. And the massive rise in rates will eventually break something in the economy. And when the news turns negative and markets and economies start weakening, I expect the Fed will reverse course and bring rates back down to near zero. And the reversal could support the equity market. The market may be hit in the beginning. And the U.S. still dominates the global financial markets, right? The U.S. stock market can show resilience and has done so far in 2023. And U.S. tech can remain strong, and a pause in rate hikes can support equity returns. And I'm raising our target allocation to 25% from 5% in gaze. The U.S. is then approximately 30% of our total equity allocation, which is significantly below the 62% weight that it is in the MSCI All Country World Index. A soft landing appears to be priced in, which constitutes a risk if the Fed fails and we start to see the economy slow considerably and the stock market starting to fall. Now, earnings for U.S. companies have surprised on the upside, and they've been upgraded. This is part of what I was saying, why I don't think it's as much of a tech bubble as we've seen, let's say, in 1999 or 2000. And that's because earnings have been very strong. But eventually, what goes up must come down, and eventually these earnings are going to start to fall. But right now, they've been relatively strong. So ECB seems open to pause given relatively weak economic data, and EU companies are resilient. They're used to operating in a sluggish growth environment, and being a global leader in industrial automation, the EU could benefit, particularly Germany, from reshoring. And investors have low expectations for the developed markets or developed Europe economic outlook. And so we see a chance for a region to surprise on the upside, and we keep our 25% allocation in gaze, the higher risk strategy. Small caps typically perform better in a recovery, and Europe appears attractive, and smaller companies generally have better growth prospects and are more agile in capitalizing on new opportunities. And we have a 3% allocation to Europe small caps in gas. Now, Japan is interesting. This chart shows that Japanese companies have been hoarding cash for the last decade. In fact, they're now sitting on $2.2 trillion in cash, which is an equivalent to about 44% of GDP. That's an incredible amount of holdings of cash by the companies. Now, high inflation in Japan means the private sector is pushed to spend and invest. Higher inflation can lead to private investments and higher consumer spending, not to lose the purchasing power. So I'm keeping our 25% target allocation to Japan in the gaze strategy. And then Latin America, this is where we've added a 3% position. If you look at that chart, and you can see how much the PE has collapsed. And remember, a lot of times we're seeing that EPS is actually somewhat weaker in these emerging type of markets like in Latin America. So EPS falling or being weak is already keeping PEs high, but you can see such a derating in the Latin American markets that I think it's worth looking at. Brazil and Mexico account for about 90% of the weight, and both countries appear to have gotten inflation down, even if Mexican inflation has decelerated. slower. We've added a 3% target allocation to gas for this one. And demand for care and drugs is independent of economic conditions or cycles. Medical procedures that were delayed due to COVID now drive demand. And we're keeping our 17% target allocation to world healthcare in gas portfolio. Here we can see strong momentum in infotech. The fund that we're using is the B Innotech, which has done pretty well relative to MSCI All Country World. And much of the year-to-date recovery in the U.S. markets and others has been driven by tech. And I think the momentum driven by positive AI sentiment can continue and have a 3% allocation into world infotech in both gas and 5% in GIPS. So infrastructure is defensive, and we keep our target allocation at 17%. It's benefiting from government's green energy security, and other infrastructure spending. And typically, predictable cash flows enable to push through cost increases from inflation. Now, before we go into bonds, I just want to, talk briefly about what's going on in the energy situation. Of course, we have people who are talking about net zero. They're talking about reducing fossil fuels and all that. The fact is that energy demand is rising, and I think it's just going to continue to rise. And why is that? Well, just look at our smartphones. Look at how much energy these things demand. And look at the EVs. They demand a huge amount of energy. And look at artificial intelligence. Just the learning phase of the artificial intelligence takes a tremendous amount of energy worldwide. The demand for energy is huge. So I think that energy companies are going to do pretty well over the next 5 or 10 years. And you'll see that they'll sometimes come into my strategy. So let's now go back to the presentation. Remember, if you have any questions, feel free to ask. So bonds are typically a safe place to be, and global bonds should bring diversification benefits to the portfolio. And we're switching to the global bonds. So in recessions, safer assets like government bonds typically have performed well. And though with high inflation, low yields could still lead to negative real returns. And we generally don't allocate to bonds to speculate on the upside, but rather use it to protect capital over time. Now, in the past, we decided to allocate to the Thai money market instead of global bonds to reduce our COVID risk exposure. And when we have decided now to return to global bonds, and we moved our bond allocation to the SEB Global Bond Fund from TMB Treasury Money Market, and in both gaze and gas. And in GIPS, we switch our core bond allocation to that fund from the K Bond Fund. Just so you know, those are some key changes that we made. Now, global bonds should bring diversification benefits. Here you can see the master fund of SCB bond fund that we're using. We've analyzed 10 global bond funds, and the 3 in the chart looked most suitable. Master Fund C, which is the red line, is highly correlated to world equity. C is the green line. So we don't really see a lot of benefit coming from the green line. So let's just see, if we look at that, we're talking about a correlation of about 70% here versus what we can see on the other ones, a correlation of about 30 and 20%. So about 30 for the red line and about 20% for the blue line. What we want is we want lower correlation because we want it to help reduce the risk in the portfolio. And that's the reason why we've switched, and that's the reason why we're using the fund that we're talking about. So here, if we look at the master fund of the SCB GLOB or Globe, basically the key thing that I like about this one is that it's 60% government exposure. I don't need to get fancy with the bond portfolio. And the previous page shows both bond funds have a relatively low correlation to world equity, but I prefer the SCB Globe as it has more exposure to government bonds versus corporate. And generally that's lowering risk. And again, what I'm looking at bonds, I'm looking at buying bonds for the purpose of protecting the downside. So The master fund is the global aggregate bond fund run by T. Rowe Price with assets under management of about $500 million US. And SCB discretionary hedge is 4x. And as of July, the hedging ratio was about 40%. So like most of the funds out there in Thailand, there's a certain amount of hedging that's going on of the risk of the US dollar. And there's a front end fee of about 0.54 and a management fee of about 0.92. So let's talk about strategies. And JR has a question, and I'm going to come back to your question, JR, in just a minute. Energy prices have come down, though oil prices raced up above $80 a barrel in April or in August. And food prices have softened but rebounded slightly in July. And commodities have rebounded. It's too early to call a turn for commodities. Here we can see that energy prices are down massively from the boom in the European natural gas. And then what we can see here is oil price has driven commodities in the second half of 2023. And that's driving up that blue line. And we can see non-energy commodities are just flat. So also food prices have softened. This was the COVID peak basically right here. And, thankfully, food prices continued to fall. And that's good because food prices crisis leads to a population crisis. And commodities have rebounded due to oil, but too early to call the turn for the group. The global economic outlook remains uncertain, and the main upside in commodities could come from a supply shock, adverse weather condition, or significantly higher demand due to an improvement in growth outlook. And I'm keeping a 5% allocation in gaze and no allocations in gas and GIPS. Gold. Central banks have been loading up on gold, maybe switching from US dollars, and gold protects value in times of uncertainties and market downturns. Here we can see that the central banks have been loading up and adding more gold. The final, you can see the second to last one shows a massive increase of buying of gold. And here, remember, this is only the first half. So maybe we want to double that to say that's roughly what we're getting during 2023. Gold has kind of just been sitting there over the last couple of years, which again is okay from my perspective because I'm looking for gold to be, something stable. Also, let's talk about risks. There's inflation reaccelerating. Central banks' aggressive rate hikes and QT crash the stock markets could happen. And poor EU and US, Japan markets could hit the gaze portfolio. A better overall sentiment could lead to underperformance of defensive sectors. And if inflation reaccelerates, we could miss out on rising commodity prices. High gold allocation and gaze could get hit by higher rates or improved market sentiment. Now, before we get into the final session of Q&A, if you have any questions, remember about the app. You can download it at iOS and at Android. I've been, impressed working with the InnovestX people who are working very hard to create this great app, improve it over time. And so you can use this app to get access to these strategies. Also, if you ever want to learn valuation, join the next Valuation Masterclass Bootcamp number 12, which starts in November 6th. Our limited super early bird price is still available. And with an InnovestX coupon code, you can save up to $100. So you can get $100 off on any price point until October 27th, meaning you're saving $800. You just use the InnovestX coupon code, or you go to Valuation Masterclass and you put it in there. You scan the barcode. All right. I'll do my best to answer some of the questions that we've got out there. Let's try to do that now. I'm going to look at that. And one of the questions is about, can you explain a little bit more about the strategies? So let me just pull something together for you. Hold on one second. I'm gonna get to that, and I'm gonna show a screen to talk about the three different strategies. So hold on one second. All right, here we go. I'm gonna share my screen again, and these are the three strategies. The first one, so this is coming from a question from JR. What's the difference of each strategy and how can I invest? So the first thing is that the GIPS strategy, which is the red line, is low risk. So if you're looking for just a little bit of return and you're looking for a small amount of volatility, you can see the red line here is very flat compared to the other lines, which have a lot of movement there. So let's make it clear. GIPS is low risk for people who are just careful with a portion of their money. Now, what we should be seeing is that the green line should be higher than the blue line here. And the reason is because the green line is the global alpha asset strategy. So to answer the question, JR, this is the strategy, global asset, alpha asset strategy, which is also called GAS. This is the strategy that is the highest risk strategy. It's been hit hard, but the point is, at this point, I would say that that's, if you've got enough money to allocate and you're thinking long term, then I would go with the global alpha asset strategy. But if you're more conservative and all that, you may want to go with the asset enhancing strategy or GAZE. All right, let's look at any other questions that we've got. Here we can see InnovestX is related to SCB. It'll be nice if you could arrange a wealth management session at the beautiful SCB Investment Center at Icon Siam. What a great idea. I love that. In fact, this past weekend, I was at Shangri-La Hotel with my mother for a staycation. And my mother would love to go to Icon Siam. So let's see if InnovestX and the SCB team can get us an event at the Wealth Management Investment Center at Icon Siam. I will be there. I will be there for sure. And hopefully you guys will be too. Let's look at why defensive sectors would underperform, like healthcare. Well, sometimes when the market's doing okay, we can see that the defensive sectors underperform in good market times because they're defensive. But there are times also where they don't perform that well. For instance, COVID time ramped up a lot of the healthcare, and then a lot of that came crashing back down. So though it appeared that it was defensive, those companies were still going through some de-rating. So that sometimes can happen. So what I would say is I'm going to stick with healthcare as a defensive sector, but I know it's not always going to be defensive. Just to highlight here, if you're interested in attending the Valuation Masterclass Bootcamp and becoming an expert in valuation, just go to the link that's in the comments there, and it looks like that. And I'll be happy to see you in that class. In fact, we meet 3 nights a week, except tonight. All right. Any other questions out there? I think the best question is, why don't we get InnovestX to set up an event at Icon Siam? All right. I think that's it for tonight. I want to thank everybody for joining. And I just want to highlight that my goal is to be long-term thinking, to have a structure for investment, and to follow that structure. Even when it's not working, stick with it. And that is really what I do. I do not go on a ride on the roller coaster of the stock market. And I know that some of my clients and some of the people who are using the strategies through the InnovestX app, I know that they're sometimes on a roller coaster. Come on with me and you'll see that I am not on a roller coaster and I don't go crazy with the markets. I want to thank everybody for coming tonight and for joining this live stream. I really appreciate it. I appreciate the questions that you guys have had. And hopefully I'll see you guys soon. Hopefully I'll see you at the InnovestX or SCB Investment Center at Icon Siam. Have a great evening and a great rest tonight.
ถ้าคุณมีเงินเก็บ
แต่ไม่รู้จะเริ่มลงทุนยังไง
ขอแนะนำเลยฮะ InnovestX แอปการลงทุนที่เข้าใจคุณมี Intelligent Portfolio บริหารพอร์ตการลงทุนอัตโนมัติ
เดี๋ยวเราดูแลแทนคุณให้ครับ
นี่เจ๋งปะจะเลือกลงทุนตามเมกะเทรนด์โลกลงทุนเพื่อพิชิตเป้าหมายหรือลงทุนตามกูรูดัง
เริ่มลงทุนได้ง่ายขึ้นเยอะเลยอ่ะ
ถ้าคุณมีเวลาน้อยแต่ข้อมูลลงทุนเยอะเรามีเลขาส่วนตัวฮะ ระบบ Personalized Notification เตือนข่าวสำคัญ
โอกาสลงทุนมาแล้ว
ให้คุณปรับพอร์ตได้ทันการ
แค่นี้ก็สบายใจละ
และถ้าคุณลงทุนหลายอย่างนู่นนี่นั่น
เลยต้องใช้หลายแอป
เปิดดูรัวขนาดนี้ระวังนิ้วหรอกนั่นไง ถ้าอย่างนั้น เรารวมให้ พี่น้องครับ Innovate X ครั้งแรกที่ลงทุนในสินทรัพย์ดิจิทัลหุ้นระดับโลก หรือสินทรัพย์ไหนๆก็มีครบ พร้อมสรุปพอร์ตให้ได้ในแอปเดียว พร้อมไหมฮะ ออกเดินทางสู่อนาคตแห่งการลงทุนกันเลย ไป วันนี้หลักทรัพย์ไทยพาณิชย์ได้เปลี่ยนเป็นหลักทรัพย์ Innovate X พร้อมพาคุณสู่การลงทุนแห่งอนาคต ครบทุกจักรวาลการลงทุน Innovate X แอปที่เข้าใจการลงทุนเพื่อทุกคนโหลดเลย ผู้ลงทุนควรทำความเข้าใจลักษณะสินค้าเงื่อนไขผลตอบแทนและความเสี่ยงก่อนตัดสินใจลงทุนการลงทุนในสินทรัพย์ดิจิทัลมีความเสี่ยงโปรดศึกษาและลงทุนให้เหมาะสมกับระดับความเสี่ยงที่ยอมรับได้